Hello, my name is Lee Garris, and today the case I'll be analysing is the Federal Commissioner of Taxation, FCT vs Maloof 2009, with the main issues discussed here being when was the expenses incurred and the timing of the deduction. So the facts of the case included the following. There was a taxpayer who was an investor with a goal to obtain the benefits of Taxation Ruling 9424. He was a partner in a partnership by the name of Cresthaven. Cresthaven were entered into arrangement to purchase property to be developed as a retirement village. The contract was entered on the terms that there would be a deposit of $6.5 million and the residue of $33,250,000 to be paid 14 days after the completion of Stage 1 of the development, which was the 25th of June 1999. Also, each investor in the syndicate financed their share of $6.5 million deposited separately. Cresthaven lodged its partnership return for the year with a partnership loss of $40,830,260 that included a deduction of $39,750,000 for the full price of the property. The taxpayer claimed a deduction of $474,457, which amounted to his partnership loss. The Australian Taxation Office judgment through the Taxation Ruling 94 and 24 was that the expenses incurred to acquiring and developing the retirement villages would be allowed on a revenue account and be deductible in the year in which the expenditure was incurred. The Commissioner accepted that the partnership was entitled to a deduction to the amount paid from the deposit of $6.5 million, but not entitled to the unpaid balance of $33,250,000 as a deduction, and therefore disallowed the balance of the deduction claimed in the year 1999 to $94,891. Following this, no significant work on the property occurred, and in February 2006 the contract was terminated and the deposit was refunded with interest. The issue is whether the partnership was able to claim a deduction of $33,350,000 in the income year of 1999, which is the purchase price of the property. The view on the ATO was that under the terms of the contract, only the deposit was incurred in 1999. The judge held that the taxpayer's obligation to pay the residue of the purchase price under a contract for the purchase of the land and development of the retirement house was incurred in the relevant year of income 1999, in which the contract was entered into. The full federal court judge responded in favour of the Commission ahead of the primary judge and said that every contract must be construed according to the intention of the parties, and upon taking legal approach, the contractual agreements and surrounding circumstances must be considered in determining when the loss or outgoing has been incurred. The Commissioner appealed to the full federal court stating that the contract remained executory until settlement, when the transfer of land or property would occur, and therefore there would be no liability or debt due to the vendor until the settlement. In this case, the settlement did not occur in the year of income of 1999, and therefore accordingly there was no debt or liability due to the taxpayer in respect to the residue of the purchase price. As a result of the case, the court held that the financial liability for the balance of the price did not occur at the time the taxpayer entered the contract. Hence, it would only occur upon settlement of the land in retirement village. At this time, the vendor would also deliver and transfer the title of the land. Hence, the court concluded that the obligation to pay the residue was not referable to the year of income of 1999. The legal principles established in this case look at the effect of expenses in terms to the tax timing of the deduction. The financial year is defined in section 9951 of the ITAA 97 as a period of 12 months beginning on the 1st of July and ending on the 30th of June. There are two types of accounting systems. They are the cash and accruals. The type that is relevant in this case is the cash basis, which states that income is recognised only when cash, or something capable of being turned into cash, is received. The cash basis method is mostly appropriate to determine income from employment and investments. These legal principles of tax timing in relation to income and expenses are still relevant today as they were in the case FCT vs Maloof in 2009. When looking at income from the sale of real property, when a sale of real property results in a gross income or results in a profit that is accessible income because the property is a revenue asset, the income arises at the time of the settlement and not when the contract is entered into, nor when all conditions other than the transfer of the property are satisfied. This can be drawn from Gasperin vs. SVT 1994 and can be applied to this case as the property has not been fully settled and therefore the excess amount of $33,250,000 isn't relevant in the income year 1999. The relevant taxation ruling, TR 9424, has now been withdrawn that applies to this case. As a result of this case, no new principles were formed, and the contract in this case is vastly different from other contracts considered, such as Raymore and Will Combers. As in this case, the agreement was unconditional. Onwards from this case, in regards to the development and purchase of a land of a retirement village, the Commissioner will consider the penalty matters should be decided in regard to the individual circumstances of each taxpayer and their actions. Also, Tax Ruling 2018/3 can be used to determine tax treatment of long-term construction contracts in relation to returning income derived and recognising expenses incurred in long-term construction projects, which is any construction work that extends beyond 1 year of income. This new ruling basically states that it is not permissible to deter the bringings of profits or losses to account until the contract is completed. Furthermore, in relation to deductible expenses using the cash basis method or the accrual basis method, with either method taxpayers should recognise incurred expenses at the same time. The Commissioner said as a broad guide, you incur an outgoing at the time you owe a present money debt that you cannot escape. The Commissioner will allow taxpayers who have deducted expenses only when they are actually paid to continue to do this. Quite simply, this means that the taxpayer in this case couldn't claim expenses from the amount of income that was currently unpaid. Even though it was meant to be paid in the future, doesn't mean you can include deductions in your taxable income. Those deductions would have been incurred when the settlement of the land and property were transferred, and after this, then the taxpayer could have included the full deductible expenses in their tax return. However, there didn't end up being any significant ones in the retirement village, and therefore these deductions on the full amount of the purchase price did not occur. The implications of this case for a tax practitioner and how the case would impact advice they give to clients is whether the expenses incurred is relevant to the particular year of income or not. The type of basis used, whether cash or accrual, could become an implication to the practitioner as to which basis their client falls under, and possibly if they need to change from one to another and the ramifications that are involved with this process. Furthermore, depending on the type of business, if the client is a sole trader in a partnership, trust, or etc., could prove problematic to determine which basis is suitable for that client, as well as what income and expenses should be included in their client's tax returns. Tax practitioners would now have an understanding due to this case about certain tax timings in relation to expenses and income when looking at investments, more particularly retirement villages, the land and property. That the expenses can only be deducted in the year that the actual transfer of property or land occurs, and not purely on the fact that an agreement may have been made in the future that the excess will be paid after a certain stage of development in the property. That sums this up. Thank you for listening.